Rolls-Royce is going through a perfect storm right now as a result of two major factors, and sell-side consensus is confused and depressed as a result of this gloomy outlook. Thankfully, it's always raining in London, and the Brits will know what to do. The first major reason is the growth of its long-term business is creating a profitability drag, as it loses money on most engine sales in order to secure the 20 to 30 years of maintenance contracts it will receive thereafter. Rolls manufactures the most efficient large engine in the world, and because of this, it's been able to lock in exclusives on Airbus's most efficient twin-aisle planes. As a result, it's taking significant amount of market share, as it's going from about a 30% share of the wide-bodied plane market to almost over 55%. This means Rolls has one of the fastest growing books of business in the commercial aerospace industry, one which is experiencing significant growth as the current fleet of planes is at a record old age of 15 years, and passenger traffic growth has remained robust despite sluggish economic growth. These fundamentals have created an unprecedented backlog of 10 years of production for Airbus. Because nearly all of Rolls' growth is coming from engines which are attached to Airbus exclusive planes, and therefore they're sold on an unlinked basis, they're sold at losses. This is despite the fact that most of these, if not all, will attach to these long-term maintenance contracts. When the company sells an engine connected to a long-term maintenance contract for 10, 15, or 20 years, it records the profits on this engine at the long-term contract margin, which could be anywhere from 10 to 40%. That's even though it breaks even or loses money on the engine sale. The shorts have rightly criticized Rolls' negligible free cash flow conversion of its civil aviation operating income. But the point is mooting right now because it's all getting better from here. Kind of reminds us of when the shorts were pressing Fiat's leverage profile at the exact time it was improving and getting better from then on. The second major factor leading to this dark and stormy environment for Rolls is its Land and Sea division, which has a pronounced exposure to oil and gas customers. These customers are facing cost cuts and capacity reductions as they look at the likelihood of the oil barrel hitting potentially a 30 handle. As one can imagine, a perfect storm is much tougher to weather at sea level than it is at 30,000 feet up in the air. However, even if oil and gas stages a cyclical recovery during our holding period, it won't move the needle as much as the company getting its civil aviation business right. And on that measure, we have some good news. There are perceptions that Rolls is mismanaged and plays in a less profitable segment of the industry. But why don't we go inside right here and take a look for ourselves? Its last CEO has recently left, and he managed to clock out with the worst performance in the industry. And in comes this guy, Warren East, who has a great track record turning ARM Holdings into a global semiconductor powerhouse. He managed this hat trick by acquiring core capabilities and providing a one-stop chip design shop with a highly technical focus on the company's ecosystem. Oh, and he bought back a lot of stock when the valuation was constructive. As he starts his first day of work across the street, we have a couple recommendations for him. All East needs to do is look west and cross the pond to see how GE managed to execute flawlessly as it grew its installed base of engines at a pretty similar pace to which Rolls will grow its base over the next 6 years. Even though engines are frequently sold at losses, GE managed to counteract a significant negative mix and restore profit margins back to previous highs. It's even guiding for them to continue their upward ascent. These profit margins are roughly double those that Rolls generates in similar segments. On the way to work, the conductor of the tube is going to have some useful advice for Warren. On the gap. Rolls is actually fairly competitive on operating and R&D expenses, but dramatically underperforms GE with its variable cost. It's outsourced far too much of the engine to a supplier base that's uncoordinated and poorly communicated with. GE pulled 3 major levers when it helped counteract the negative engine sales mix. It invested in first, factories, second, 3D printing capability, and third, selectively acquired companies where it had substantial cost-saving opportunities. So the first, it has built 7 new factories to claw back work from the supply chain that it could do more efficiently. It then used 3D printing capability to increase its specialized manufacturing abilities. It can now 3D print the most value-added part of the entire engine, the high-pressure turbine blades. Lastly, it was able to extract such robust cost savings from its Avio acquisition that a sizable portion of the engine now earns over 20% margins versus 0 before. Pulling all these levers together in one chart, one can see on a theoretical basis, it's been able to increase the profitability of its engine sales by 10 percentage points in the last few years. If Rolls could pull this off, shares would be worth over 5 times where they trade today. The best criticism against an investment today in Rolls is that we're a little bit early, as 2016 represents the weakest point of its transition from linked to unlinked engines. We think this point is moot because the current valuation is already overly discounted in this scenario, and the company remains one of the cheapest companies in the entire aerospace and defense industry. This is despite it having better growth prospects and higher competitive barriers to entry. Furthermore, the company's new CEO, Warren East, is embarking on a detailed strategy and operational overview. We're confident that he can bring his engineering and technical background to find and fix the inefficiencies that lie in the supply chain, which account for 75 to 80% of the value of each engine. We've talked with many of these disgruntled and uncoordinated suppliers, and we're confident that Rolls has a significant chance to improve relations with its supply chain. As it does this, it may actually achieve some of these 15% cost reductions that it's seeking across the board. If the new management team seriously delivers and the company is able to emulate the flight path of GE in the last 8 years, they can turn highly satisfactory returns into truly wonderful performance. So as East assumes the helm of Rolls, we're hopeful that he uses the same playbook that he used at ARM, which was namely to acquire key capability to allow the company to dominate its industry and return prodigious amounts of cash to shareholders. So as these stormy conditions moderate in the next 12 to 18 months, investors will once again realize this is a fantastic business with very high margin services and a company that is taking market share within a duopolistic market structure in the fastest growing segment of the aerospace industry, which is one of the fastest growing in the world, and now has a great new CEO with a fresh perspective to help fix the one pain point in the business. It's a lot to take in, but even perfect storms don't last forever.